Okay, today we're going to cover reading a stock ticker. Now, I don't know if that's the official name, right? But like the idea is whenever I think of a stock ticker, all the information about a stock, you think of like the 1920s tickers where it's like ding, 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 ding. And that's where it tells you the current, cost or the price of the stock. For us, we get so much more information than just the old ding, 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 ding. We get to know anything and everything about that stock that we want. And it gives us information, and therefore we can make an informed decision. So I want to go over the information that's readily available, utilize kind of layman terms just so that you know what you're looking at. That way, if you're considering, going into the investment, you're looking at a certain percentage of the TE30, perhaps you can't get all 30 of them and you want to get a few of them that are more aligned to kind of your investing appetite, or even if you're looking at other stocks and you're trying to consider which of the stocks to go with. Being able to read the stock ticker, being able to understand the information will allow you to align your priorities to your investment. Risk versus reward is always the question, right? High risk, low reward, high reward. Sorry, did I say that right? Yeah, high risk, high reward, low risk, low reward, right? And there's always the truth somewhere in the middle. But as you're trying to kind of balance out your portfolio or make the investments that align to your priorities, really understanding what stock you're buying into is important. Therefore, learning how to read the information becomes important. So let me share my screen real quick. We'll go through essentially a stock ticker, and let me dive into the information. So any company that you utilize is going to look pretty similar. Everybody's going to have their own nuances. I get it. This is the E-Trade portfolio, kind of the E-Trade interface that you're looking at. You go to Webull or you go to, Robinhood, anything along those lines. They're going to look somewhat similar once you drill in to the snapshot or the stock details. So we're just going to go through the snapshot. There are a lot of other things that you can go into: charts, news, options, right? But snapshot, let's take it day one, step one. We're going to look at the snapshot, and I'm going to work through this. So this is the Verizon stock, right? So you can see the name of the company is Verizon Communications, right? However, it always has its little, stock name. It's VZ. So that is the Verizon stock. I have the Verizon phone. Again, a lot of the investments that I make are things that I use on a daily basis. If you use it, right, then it's probably because you believe in it, and you should really be investing in companies that you believe in. Verizon is the phone company that we use in my family, and so Verizon's in the TE30. Let me walk you through it. So Verizon's current stock price is $53.62. This represents a $1.27 increase over yesterday. So in essence, what that means is yesterday, its previous close was $52.35, which you can actually see here on the previous close. It's up $1.27. To put that into percentages, and percentages is all we care about. To put it into percentages, Verizon's up 2.43%. That is a killer day. I understand if you're watching Bitcoin and things in the news, or if you're chasing penny stocks, you're looking for 6% and 7%. It's like if you can get a very good company with a multi-billion-dollar valuation with product to grow by 2.43% on a daily basis, it's killing it. And Verizon's killing it for a number of reasons, which I can talk about a little bit. It just pushed out its financials, so it gave its earnings per share, which we're going to cover, right? And it raised its guidance. So I'm going to cover those kind of elements. So when you read an article and it says it beat their earnings per share, well, let's talk about what that actually means, right? And from a guidance perspective, what's the goal? But when you give good news, basically your stock goes up. When you give bad news, your stock goes down. Verizon gave a lot of good news, which is why it's up 2.43%. Now, we only care about percentages, right? A stock can be $10 or it can be $1,000. And so a stock that grows by $5 on a daily basis, that's really good news if the stock's worth $10. That's really very small news if the stock's worth $1,000, or if to buy a stock is $1,000. So getting hung up on the actual dollar amount instead of the percentage of change can be a bit misleading. So always look percentage of change. Percentages don't lie. Percentages scale depending on the stock price. So always go with kind of the percentages. Then you're going to see something called the bid. The bid is in essence the price that you can buy it at. So right now you can buy it at $53.62. The ask is what you would sell it at, or what's, what you could, if you will, the most you could sell it at, $53.63. Stocks like Verizon, big companies that push a lot of stocks, the bid and the ask are typically going to be a penny apart. Very rarely will you ever see it more than a penny apart. If you ever do see the bid and the ask, differentiated a lot, you're going to see this if you start to invest in a lot of penny stocks, a lot of stocks that aren't getting pushed a lot, where there's just continual buyers and sellers transitioning. And so therefore, what will happen is the bid and the ask will be create a bigger gap, where in essence, you've got to buy it at a smaller price than the person selling it. And through that transaction, because that transaction might take time, that gap would close. Or what you can see also in a lot of the Bitcoin or the cryptos is that that gap will be big, and a company like a Robinhood or a Webull that utilizes or enables kind of crypto, they make money on that gap, right? What someone sells it, what you buy it for, they make it on that little bit of kind of float. So, and if you see a big gap between big versus ask, again, you should just recognize that you're buying into a stock or some level of an asset that's not trading hands a lot, or that's not readily available. A company like Verizon, where there are a lot of shares out there and available, which you can see right here, shares outstanding, 4.1 billion shares. That's a lot of shares. That's not share price. That's actual like certificates of a share, a percentage of ownership in the company. There's 4.1 billion shares, right? And then from a volume perspective, this is how many shares are getting moved today. 20 million shares are getting moved today. With that many shares moving, right, you're going to see the bid and the ask very close. Smaller companies where maybe the volume is much lower, right, the shares outstanding maybe lower, collectively, you're going to see the bid and the ask a little bit more, wide by way of a gap. So if you want to know if you're investing in an area where a lot of other people are investing, one real simple way is to look at the bid and the ask. It's a very good indicator as to whether or not this is getting moved a lot. So that's your top, those are your main ticket items, right? Current price, percentage, and dollar of change, and then what's the bid and the ask? What can you buy it at? What can you sell it at? Now you get in kind of the details of the snapshot. We're going to cover these kind of elements. Open is in essence, what was the price at 8:30 Central this morning? What did it open at? Previous close was what it closed at yesterday, 3:30 p.m. Central. What did it close at? You're very rarely ever going to see these two numbers equal each other because stocks move after hours. You can even, with E-Trade, you can even get into a situation where you can make after hours, purchases, which is kind of cool. Stocks don't move a lot after hours or pre-hours, but they do move some. And so in those movements, you'll see price adjustments. Typically, it's not a big adjustment. During earnings seasons, sometimes you can see bigger adjustments. I talked about this in one of my previous videos where we had a firm, and a firm did their, in essence, the previous close was like, I think $95. And then they gave their earnings report and they blew it out. They talked about the Amazon relationship, and it jumped like 40%. Boom, right? The open and the close were quite different that day, but every other day for that quarter, they were pretty close, probably pennies, nickels, dimes, quarters, maybe $1 of difference, but generally not much. But it does show you kind of how the stock is moving after hours and then how it's moving for the day. It's all about giving you information again to understand where the movement's coming from, and therefore, is it time to buy, is it time to sell, or is it time to sit? Volume, I already talked about it a little bit. This is the amount of shares or stock that are changing hands on a daily basis. So today, for example, 20.9 million stocks, shares have changed hands. But the last 10 days, the daily average has been 25 million. So not too volatile, even though it's got good information, probably means a lot of people are kind of sitting on it and really not moving, which is a reflection over here of like the analyst research, right? So equal weight, moderate buy, a lot of suggestions to hold the stock. You're not seeing a big spike on sellers or a big spike on buyers. That in fact, it's below its 10-day, rolling average, even with this good news. A lot of people just kind of sitting there waiting on it. Now, you're going to see that happen a lot because Verizon gives a dividend. And we'll talk about that in a second as we break through, but dividend stocks typically are lower risk stocks. They're stocks that essentially redistribute their profits back to their shareholders. They pay these profits back via a dividend. It's called dividend. And when a company pays a dividend, there's a lot of holding of that stock. You have to hold the stock in order to get paid the dividend. So it's much less volatile. You're not going to see the big swings. So there's typically also not big ups, but when you remove the big ups, you can also remove the big downs. So Verizon, not a lot of stocks exchanging hands in that regard, but a very safe, kind of calmer type of an investment. I'm going to get to market cap in a second because I want to highlight something before I do. The days range is just essentially the price range of the stock during this day. So its low was $52.72, and then its high, where it's currently at, is near its high at $53.74. A lot can happen in a stock in a single day. So watching that days range will tell you, are you on a downswing, on that stock? Are you on an upswing? Or are you kind of right in the middle? But also it can show you the volatility during that 24-hour kind of session. 52-week range now just extends the idea of a day range, same concept, but just for the whole year. What was the low, and even the date of the low, which you can actually see was recent, $50.86. Whereas the 52-week high, $61.95, that happened in December, right after the elections. We had this big spike in the stock market. And that's where it got its high. So right now it's at $53. So what I can see here is that its high is about $8 more than what it currently is, which represents roughly around a 15 to 17% uptick, possibility that if it gets back to its high, there's about 18% growth there. That's a pretty dang good growth. I like the Verizon stock where it's at right now. It's got some good upside to get back to its highs. And again, like I said, it pays that dividend, so it's also a much safer investment. Now, I said I would get back to the market cap, but I need to be able to talk about shares outstanding real quick. I did highlight 4.1 billion shares, crazy amount of shares. Like companies like Apple, Verizon, they have so many shares that it blows your mind as a company owner, right? Like our company has 10 million shares, which even seems big. But then you start talking about 4.1 billion shares, it's craziness. But a market cap is in essence the value of Verizon, not the profits it makes, right? It's the value of Verizon. And so if you take the shares outstanding, 4.1 billion, and you multiply it by the price per share, that's where you get your market cap. So a company's market cap can go up or down very, if you will, very aggressively, depending on how risky the company is, because the share price goes up and down. So you'll hear about like Apple and Tesla and these companies where maybe the market cap is a couple trillion. That's not their profits. That's not the money that they make. That's essentially the valuation of the company based on how many shares do they have, shares outstanding, and the price of those shares, right? So that calculates the value of the company. The value of the company is always based on a multiple. And so you can see the multiple right here, price to earnings, P&E. P&E is huge. If you're making an investment, you need to understand the P&E, because the P&E in essence shows you the value of the stock, right, to the earnings of the stock, which is called the earnings per share, the EPS. This is how much, for every share, 4.1 billion shares, how much profit did each share generate last year? $4.83. So each share, if you own one share of Verizon, you in essence earned $4.83 in profits. However, the stock's not valued at $4.83 because people buy stocks based on forward projections, right? And so they put a multiple on it. They say, ooh, $4.83 of profits. Okay, I'll buy that from you at $53.62, which in essence means 11.48x. The price of the stock, $53.62, divided by the earnings, if you will, the earnings per stock, right? To get to $53.62, you had to take the earnings and you multiplied it by 11.48. Now, this number, the P&E, is going to change all times. this earnings per stock will stay the same for the trailing 12 months. So TTM, trailing 12 months. So for the last 12 months, it earned $4.83. This number won't change until next quarter when they do their next earnings report. Then that number will change. However, the P&E changes every day because as the stock price goes up or goes down, right, the multiplier, which you take the earnings, the $4.83, the multiplier that creates the value of the share, the value of this, that multiplier changes as the value of the share changes. So for example, if this stock goes up to $60 tomorrow, right, the P&E would increase to about 12x, right? And so the bigger that P&E, in essence, the more people are buying it based on very positive projections of forward earnings or how they think the company is going to do in the future. So when you see a P&E that's really big, it basically means emotion has swelled that number. It's not really swelled because of earnings. It's swelled because people believe the future of that company is going to increase earnings dramatically. So a low P&E like an 11.48, which happens to be a very low P&E, this really shows that people aren't putting a lot of emotion in it. So therefore it's not a very expensive stock. It's trading currently at 11.48x of earnings. Now you're going to get other stocks like Upstart, which I like a lot. Let me show you here real quick. Upstart, for example, is trading at 563x. So 11x, 563x, right? 563x says, we understand that the earnings per share is 39 cents, but we believe Upstart's a young company and we're crazy excited for what's going to happen over the next 10 years. Boom, boom, boom. And so everybody is really putting a lot of emotion into this purchase. It's not truly supported by earnings today. It's supported by our projections for earnings tomorrow. So the smaller the P&E, right, the more founded the value of that stock. However, the smaller the P&E typically means also that people aren't as high or excited about the future of that company or how it's going to grow in the future. So Verizon, real low P&E means it's a very conservative stock. Again, very safe. All of these are pointing towards very safe. Upstart's at 563 P&E. 563x P&E means not, it's a very risky stock. A lot of emotion's been built into the price, which means emotion can change. One quarterly finding can adjust the earnings per share and therefore diminish the emotion or the excitement around it. And all of a sudden the stock price can go down by like 20%, like real quick, right? You won't typically see like a Verizon go down by 20% because so much of the stock price is actually built around its earnings. And there's not a lot of emotion to that. So just recognize a big P&E, a really big number on the P&E means a lot of excitement and a lot of emotion built behind it. It means that could do a lot of great things, but it's also a riskier investment. Smaller PE means it's really built upon the earnings, much more solid type of an investment. Again, neither of them are wrong or right. It's really just a function of aligning to your appetite and what you're trying to do, you build by way of a risk reward. The last thing I want to talk about on the snapshot is dividends, right? So real quick, let me show you Upstart. If you ever see blanks like this, it means they don't pay a dividend. They have decided to keep their profits in-house to utilize it for growing their company. This is a growth company. Growth companies don't typically pay dividends. They keep their company so that they can grow aggressively. An organization like Verizon, who's been around for a long time, they eventually can't grow as aggressively by way of percentage. They can't grow as aggressively as like an Upstart. So they start to keep, they hold on to a lot of their profits. In fact, they hold on to 95% of their profits. But the other 5% of their profits, they distribute their earnings to their shareholders, who are the owners of their company. This is free money, by the way. This is pretty awesome. I love free money. Free money's legit. But there's a trade-off. Typically, if a company's paying a dividend, they're not going to grow at the same rate as a company not paying the dividend, right? So you have to kind of trade that off as you look at your risk reward. But A company like Verizon, their dividend yield is 4.89%. Huge. It's so big. Anybody over like 2%, 3% is a big dividend payer. Apple is less than 1%, to put it into perspective. Verizon, nearly 5% right now. Because during their last earnings call, they said that the dividend, Q4 dividend, is going to be 64 cents for every share that you own. So for every share you own, if you own 1 share, of Verizon, you get 64 cents. They give it to you. If you own 10 shares of Verizon, you get $6.40. You own, let's say, 100 shares of Verizon, right? 100 shares of Verizon, you get $64. Like, it's really good. Sorry, it's a really, really good, dividend. Like I said, 4.89% is legit. So Verizon sets the 64 cents a share. The 4.89% is very much like the P&E. It is going to consistently change every day with the price of the stock, because the price of the stock is going to dictate, in essence, how big that dividend yield is, because 64 cents, right, is it, in essence, divided by this $53.62. So the dividend, the quarterly dividend times 4, because it's a quarterly dividend, so 4 divided by the price of the share gives you the yield. So this number will change every day. It's not going to change dramatically, right? If Verizon goes to $20, this dividend yield will go way up, because at 64 cents times 4 divided by the price of the stock, that dividend yield is huge. It's like 20x. Nobody does that. If Verizon goes up a lot, like from $53 a share to $100 a share, you'll see this dividend yield go way down to like $2, or I'm sorry, to 2%. The 64 cents never changed, right? The dividend yield tells you the percentage of that 64 cents to the actual cost of purchasing the stock. So that's going to change all the time. At 4.89% is awesome. What Verizon handles is the 64 cents. And a lot of big dividend payers, what you'll see is every quarter they're going to raise their dividend. They want to do it every quarter. They might only raise it a cent. 64 cents might go to 65 cents. But 10, 15 years of ownership of this stock, that's pretty nice. That dividend can continue to grow and you get paid every quarter for it. Now, the ex-dividend date essentially means whoever owns that stock on 10/7 gets paid the dividend. So if you buy into Verizon on 10/5, you would qualify for the 64 cents dividend. However, if you bought your Verizon stock on 10/8, right, on the 8th of October, you would not get the dividend. So whoever owns it on the 7th, whoever is the owner on record, they get paid the dividend. What that also means, though, is if you own it on the 7th, but then you sell it on the 9th, you still get the dividend. And there's a lot of people who try to play that kind of time frame. We can talk about that in a later video. But whoever owns it on the 7th gets paid the dividend. Not who owns it on the 6th, not who owns it on the 8th. Whoever owns it on the 7th gets paid the dividend. So you want to know this date, because if you're contemplating buying into like a Verizon and today's the 5th and you're thinking, I might buy into it, better buy into it now, because you're going to miss out on a dividend if you wait 4 or 5 days. But if it's 10/13 and you're still trying to decide, and you got time, maybe the dividend, isn't even up for another 3 months. So you got some time. This date becomes important to let you know whether or not you qualify for the dividend payment. Now, dividend payable date is actually when the dividend gets paid. So whoever owns it on 10/7 gets the dividend, and the dividend then gets hit right into your brokerage account on November 1. It's a pretty quick turnaround. A lot of the bigger companies will turn that money around pretty quick because they've got cash flow on hand. Smaller companies, you might have to wait 30, 60, maybe even 90 days sometimes for the payment to come. But they always put it on their dividend payable date. So the last thing up here is the next earnings date. And this, in essence, tells you, right? And I just said Verizon just did their earnings today, 10/20. And so tomorrow, this will essentially be blank until they decide on what their next earnings date is. And then they'll populate that date in there too. This is a really important date to always watch for, as companies' earnings have big indicators, they have big influences on their stock price. You kind of want to know their earnings dates so that you know whether it's time to get in, time to get out, or time to at minimum pay attention. So this is the snapshot. This is what we're going to cover in today's video. We'll get much further into that about what you can do with dividends and things of that nature, as well as just like analyst research. We'll cover that in another one. But next time you read a headline like this, Verizon shares higher by 2%, following beat on EPS and raised FY 2021 guidance. In essence, that means is the Verizon shares are now 2% higher. So here you go, 2.43% higher, following a beat on their earnings per share, right? The profit per share. So the total profits that they've earned divided by their shares outstanding generates their trailing 12 months EPS, so their earnings per share. So whatever they projected earnings per share, whatever the masses thought they would do earnings per share, they beat that. $4.83 was better than what people expected. And they raised their fiscal year 2021 guidance, which means essentially what they think they're going to do for the rest of the year, for the rest of the upcoming fiscal year. Whatever people thought they were going to do, they just gave a guidance or a projection that was higher. So if your results are higher and your forward projections are higher, typically your stock's going to go higher, right? But hopefully now, this is the snapshot. Hopefully now you kind of know what you're looking at. We're going to go over next time the actual charts, the different times, as well as analyst research. But if you understand the snapshot, you can understand the stock. You can also understand then when you get those kind of headlines like Verizon's up 2% because of an EPS beat. Well, that just means their earnings per share, their profits, are better than they anticipated. And their forward guidance is also better. When you hear that, you know the stock's probably going to be making a little bit of a run. Maybe a short-term run for a couple of days, maybe in a couple of weeks, but they're going to make a run because their numbers are looking great. And who doesn't want to buy into a great company?